Most people think life insurance is just about protecting your family if something happens to you. But what if I told you it's one of the most powerful financial tools the wealthy have used for over 100 years and counting to build, grow, and protect generational wealth? Let's break it all down. Here's everything you need to know in about 10 minutes. I'm going to get into 5 separate points right here. Let's start with number 1. What life insurance really is. Life insurance isn't just a death benefit, it's a financial tool. Think of a Swiss financial army knife. The right policy can protect your family and, of course, your money. And here's what I mean by that. A lot of people buy term insurance while they're working, and it is helpful. But keep in mind that term is going to expire. If you purchase the wrong kind of policy and you pass away after the policy expired, well, then you lose that death benefit, which is part of another rate of return in your life, which we'll get into later, and that's called an eternal rate of return. So let's get into 2 main types. Number 1 is term insurance, which I just mentioned. It's like rent coverage for a period of time. And then there's permanent, which builds cash value, think of a savings account, over time, and it lasts your whole life. So what does that mean? When you have term insurance, 99.99% of the time, the person that's insured outlives the term. When you have whole life insurance, where when you pass away is when it passes away, if it's structured the right way, whole life insurance becomes a turbocharger or an eternal rate of return. You're like, what is an eternal rate of return? Well, think of it this way. If I have a death benefit that never dies, and I'm in my 50s, 60s, 70s, and 80s, and that death benefit hypothetically is $1 million, and I have $1 million stock portfolio, well, instead of living on the interest of that stock portfolio, which would be 4% or $40,000 a year, keeping the principal intact, why not spend that whole thing down over a 10, 20, 30-year period, knowing a death benefit is going to replace that? That is a rate of return that's hard to measure, and that's why we call it an eternal rate of return, because you're taking 2 separate assets, you're integrating and coordinating them for the benefit of your pocket from a tax perspective as well as from an efficiency perspective. Point number 2, why most people get it wrong. Well, a lot of insurance out there are going to sell a lot of term insurance to people and tell them to invest the difference. And when they invest the difference, my biggest question is, where do they invest it? Do they invest it into the S&P 500? Do they invest it back into the business? Do they put it into one stock? And how do they measure that over 10, 20, 30 years? Furthermore, if they're going to invest the difference and it's with after-tax dollars and that difference is earning a rate of return, where do they pay the taxes out of that rate of return? For example, if I have $100,000 in an S&P and an after-tax account, it earns 10%, or $10,000, and I owe $2,000, $3,000 in taxes on it. Do I pay it out of the principal, or do I pay it out of my earned income or my W-2 job? This is important because once you understand that, you're subjecting yourself to lost opportunity cost as well as sequence of returns rate risk. Furthermore, if you're going to invest this in your business, well, okay, if your business is producing revenues, right, that's one thing. But the real question is, what is profit? Profit and revenues are 2 different things. You can make a million in revenues and have $1 profit, or $1 million in revenues and have $500,000 in profit. You must understand the micro distinctions when it comes to term and invest the difference, because remember, at some point, no matter what, 99.9% of the time, I said it above, the term is going to run out of time. And another reason why most people get it wrong is they don't know how permanent policies like whole life or IULs can be used as a private bank, funded, protected, and tax advantage. Now, what does that actually mean? Well, when you overfund a policy, a whole life or an IUL, let's stick with a whole life for this example. When you overfund it and you leverage it for other opportunities, you create all kinds of tax advantages. And by the way, at the end of this video, we're going to want you to click the link below. I'm having a virtual live event on April 10th at 8 p.m. on the east side, 5 p.m. on the west side. I'm going to go specifically into tax advantages when it comes to your small business owners that are out there, as well as how life insurance can be used in that manner, not only as a bank, but also as a pension strategy to put more money in your pocket where it belongs. Point number 3, the wealth strategy the wealthy don't talk about. And let's get into the Rockefellers, folks. The Rockefellers didn't just get rich. They built a system. They used life insurance to create generational wealth, fund trusts, and control their legacy from the grave. Now, listen, you see a lot of videos about the waterfall method that's out there. I've done some myself, and it really is 8 generations of Rockefellers, making sure each and every one of the people inside that family get life insurance inside that family let's call it the family trust, that allows them to borrow from these policies, get mortgages, buy businesses, so on and so forth. And as a result of it, as each member of the family does shuffle off this mortal coil, it goes back into that family trust. And this has been proven now for 8 generations. So we like to be able to follow what the successful people do, what the wealthy do, and be able to bring it to you, even if it's on a smaller level. Let's get your big toe wet kind of level. And it's important to understand that if they did it, you could do it as well. So what the Rockefellers did, instead of leaving money to their kids, they left a plan. An insurance policy was the core of it. Their wealth is still around today because of that system. And I said it earlier, it's important to understand that in this trust, they created rules, regulations, obligations. If you wanted to be part of this, this is what you had to do. It's not like, just because somebody hit, one of your family members hit the lotto, or you have a family member that's a professional athlete, they're just going to give you $20,000 for a car. No. They created a bank around that family loan, and you receiving that money, the family member had to pay it back the right way and learn all the right disciplines that is necessary in the game of life when it comes to money, time, freedom. Point number 4, folks, we love this, and it's easier than you think, how to use life insurance like a bank. With the right permanent policy, you could borrow from your own cash value, not the death benefit, on your terms. No credit check, and still earn uninterrupted compounding interest. So what does that mean? If you get with a carrier that has what we call non-direct recognition and you borrow from that policy, you're still going to get dividends and interest. But think of it this way. If I have $100,000 in cash value and I borrow 50, that $100,000 is still earning a rate of return while the 50 goes to work into another asset class, whether it's buying rental real estate, whether it's financing your own debt, or buying into other income producing businesses. That $50,000 turning a rate of return in the policy, and now it's going to earn a rate of return in another business over here. That essentially, in a high level, is what Become Your Own Bank is all about. Last but not least, point number 5, let's stay alive. The key is in the design, not the product. Most agents sell you the max commission policies, not us, folks. Not the max. We want to be able to give you the best performing policies, and the real strategy is how the policy is structured. So let me get into that, what that means. When you look at a whole life policy and, you look at that cash value in the early couple of years, and if there's no cash value built up, it is probably not a Become Your Own Bank policy. I'm not saying it's a bad policy, because over 30, 40, 50 years, including the distribution of that policy, it may perform better than an IRA or 401k, but it certainly isn't Become Your Own Bank. So what's important to know is when you sit down with an agent, and by the way, we'd love to be able to help you with that, you want to find out what your monthly savings is, and then the dump-in amount is the amount that you're going to be using to overfund or create that Become Your Own Bank policy. We could show you how to do that step by step, and we're really good at it, but here's what you really need to think about. When you have life insurance and you dump money in there, eventually in retirement, you get to take that money out. If you want to take it out in a stream of income, anything that you put into that policy up to basis comes back to you tax-free under the LIFO method of taxation. To maintain that tax-free status, though, you would then borrow from the policy. So what does that look like 20, 30, 40, 50 years later? The policy gets stronger and stronger, especially if it's a whole life policy where the cost of insurance is removed. Unlike an IUL, the policy gets stronger and stronger on the distribution side. It's easy to borrow it and still, or borrow from it and still earn that rate of return and not pay taxes on it. Anyway, with the right design, your life insurance becomes a powerful asset, not just a payment. And remember, this is important. I want everyone to realize this. We're not saying don't put money in the S&P. We're not saying don't buy term insurance. Here's what we're saying. All three have their place, right? So think of a Venn diagram, right in the middle. We do believe in money being diversified within and amongst asset classes. We do believe that while you're owning whole life or IUL, having term insurance in there can be a good thing, especially if you want to overfund it. But just know that term is going to expire at some point. And if you're going to invest the difference into an S&P, great, but why not have all three of those worlds work for your benefit instead of having different agents or different advisors giving you different information? Want to learn more? If this opened your eyes and you want to dive deeper into real strategies the wealthy use to protect and build their legacy, join my free live virtual event on April 10th on the east side. It's 8 o'clock. On the west side, it's 5 p.m. We're breaking it all down. Number 1, how to structure policies like a pro. Number 2, and this is important, real life case studies and scenarios. And why is this the number 1 misunderstood wealth building tool in America? It's an important question you want to ask. Well, we're going to be able to answer it for you. Spots are limited. Come ready to take action and take notes. You'll walk away with more education than you did before you started the event.